So, good afternoon, everyone. It is your guy, Dave P. and RJ Pepino, and we have a very special guest today because RJ and I are at a real estate conference. This is a group that we've been part of for many years. It's called Freedom Founders, and this is actually a group full of different dentists and different people in the medical field and dentistry who also have taken a liking to real estate, and this is where we raise a lot of private capital, and this is where we find a lot of our private lenders here at Freedom Founders. And one of our investors, his name is Tim, he has a nephew, and today we've got Nathan, and Nathan is aspiring to be a real estate investor. He is, I'll let him kind of fill you in on where he's at on his journey right now, but he's been following RJ and I for a little while. And Nathan, how long have you been following RJ and myself? I don't know if you follow me.
Yeah,
probably.
Follow
RJ on TikTok, right?
Instagram.
IG.
Instagram and then Facebook. Well, both y'all on Instagram and Facebook. So
what to talk about?
Probably I've been following for close to a year and got into this through my uncle who was a dentist, or is a dentist still, and he started learning about alternative investing and real estate. So, he went to his conferences and like, there's something to this, you need to do this, follow Dave, follow RJ. And so started following and watching what you guys do, which is pretty special. And I just recently branched out and bought a vacation home. And
short-term rental, right? Short-term rental,
yeah.
Airbnb,
VRBO, and now I want to excel myself forward to be able to buy multiple units. So, I have a few questions that I'd like to ask, get y'all's opinion on about what I need to do to not spend all of my capital to be able to do it the smartest way possible. So I guess with that,
yes,
I'll go ahead and ask.
Sure, fire away.
One of the first questions is, how do you find deals that nobody else can find? That seems to be one of the biggest hurdles that I have. You have realtors who are going to give you this, but typically on market, if there's something wrong with them, it seems that there's a reason why nobody's bought them, because the value isn't there, right? So how are y'all finding these off-market deals?
RJ, I'll have you answer that, but what Nathan's saying is how do you find the off-market deals, the good deals that nobody else has access to? Because if we're just relying on stuff that's on the market with a realtor, what Nathan said is if it's on the market and no one's bought it yet, obviously there's something wrong with it, because the market is so stinking hot right now that anything that goes on the market, if it's a good deal, it's going to get bought up or bid up very quickly. So RJ, I'll throw it over to you. How are we finding off-market opportunities to purchase?
Well, Nathan mentioned something about realtors. So you can still work with realtors, okay? The realtors that understand that, off-market properties are going to get you the best discount. And so what Dave and I have created here is, we have off-market strategies that our company's consistently putting out marketing through channels of cold calling, ringless voicemail, direct mail. We're looking into TV, and what's always worked for us is those channels that, cold calling is the best channel that we've kind of uncovered here in the last 2 years. If you are going to work with a realtor, which we feel like realtor relationships are really important right now, they have to understand how to find off-market properties, because finding them on the MLS, you're not going to get the deal flow that you want, or you're not going to get the best discount unless something is wrong with that MLS listing, right? So if you want consistent deal flow, we show you how to do that through those channels: direct mail, text, and cold calling, and ringless voicemail. And what we do is we pull these lists from list brokers. We like to use PropStream, right? And then we get the list. So there's motivation of tired landlords, there's high equity, there's a vacant list. We also pull lists from county records. Yeah. So for example, Nathan, if you're gonna target a specific area, I think you're somewhere in Alabama near the coast.
Wait, you're in Louisiana?
Well, I bought my vacation rental in Alabama.
In Alabama.
Yeah.
Okay.
So first step is, okay, let's target this specific area. So it might be a zip code in Alabama. What you can do is you can search that county for records of bankruptcy. That's people that are facing bankruptcy or maybe filed bankruptcy. They might have real estate. Another one is probate. You can actually go to your county and get the probate list, or you can go and find a list broker that might be specific to the motivation of finding the probate list in that specific zip code. So if this vacation rental that you have is in a particular area, you can go and U.S. lead list is where you can get the probate list, where you don't have to go down to the county. So you can basically buy lists, then you get the list, but you have to get the right phone numbers and skip trace them. You get the list, you skip trace them, you can send them direct mail, text, and do all the channels. Now, if you're going to do it on your own, we can certainly help you. We have certain scripts that we use. We've kind of, customized it to work for us in Ohio, but you can take those same principles and use it in Alabama.
So what RJ is saying is start with the geography, start with where you want to do this, and we suggest picking a geography where there's actually deals, meaning like affordable housing. You don't want to be on the highest end, you don't want to go after the coastal properties. Maybe you do, but the likelihood of getting a deal is going to be easiest if you're kind of in that bread and butter price range. So not the highest end mansions, but also not the lowest end war zones is what we call those. But what RJ said is, yes, pick your geography first, and then within that geography, you need access to data. We're not just opening the phone book and calling everybody in this geographical area. We want to target people with a higher likelihood of motivation. So RJ had mentioned people who file for bankruptcy. If they own real estate and it was not included in the bankruptcy, those make good leads. Another list we target are people who have code violations against their house, because this is all public record. So code violations, people who are filing divorce, people who have inherited a property, and when you're working the probate list, you want to go after, obviously not the person who is deceased, you want to go after the executor of the estate. This is the person who is now handling the affairs, and they can make the decision on selling this piece of real estate if there was real estate included in the estate. So RJ mentioned, yes, we do a lot of marketing to find these off-market deals, but it really starts with the data. You need to know who to market to, and that is how you find off-market deals. You pick your geography, but then go after people with likelihood of motivation that own real estate in that geography.
Then the next step, Nathan, is you got to formulate your offer.
Right.
So you really got to get clear on, what your property is worth, which is called the after repair value. You can, you can use PropStream and it'll tell you what value it is, and then you can also pull up comps. If you don't have access to that, you can do the freeway, which Redfin and Zillow and Realtor.com can give you some comps there too. But once you understand what your property is worth, then you can work backwards by the formula that we use is the ARV. You times that by 70%, so you knock off 70%, and then now you need to factor in how much repairs this is going to be. So you minus that, so ARV minus 70% minus repairs, and since you're gonna keep these,
right.
We have a specific way of how we do our buys, but your model might be different than ours. But I'm just giving you just some good, basics to go off of. You get what the property is worth. You times that by 70% because you want equity, and then you put the repairs in there, and then you formulate what your max allowable offer is going to be, and you offer just slightly under that.
Right.
So, knowing what the property is worth, knowing how to estimate repairs over the phone or on paper. If you, we show you how to make the offers over the phone, but a lot of these sellers are probably going to want to meet you face to face. And in that case, you meet them face to face and you get the contract right there. So that would be the next step. Then you actually got to make the offer, get it in contract. Now, we're here at a private money event. Okay, you gotta also have access to capital to take it down.
Absolutely. So funding the deal is the next thing. And the reason we use private lenders when we are buying the properties off market as is because a lot of times, I mean, if we're going to buy this thing for, 60 cents on the dollar or whatever deal that we're getting, you got to act fast. This person is obviously motivated. If there is not motivation for this person, there's no way they're going to sell you the deal at a deep discount. But when you find the motivated seller who is ready to go and they just want, to act quickly, you cannot rely on a bank to fund this thing. You've got to work with a private lender like your uncle. His uncle is one of our private lenders, and that's what we call one of our private lenders, like your uncle, and they're going to wire the money right to the escrow company, to the title company, and that's where the seller's going to show up, and they're selling the house, and the money's sitting there from our private lender, and then us as the buyer, we're going to sign off to buy the house. But what we're also doing when we're buying the house is we're signing a note, a promissory note to pay back our lender, and then we're signing a mortgage, which is nothing more than a lien. So a lot of private lenders like working with us because their money is secured in what is called a first position lien. It is the strongest position to be in. That's the way liens work. It's like a chain of, I want to say chain of title, or it's like basically there's a first position, and then which is the senior lien, and then any other liens like a mechanic's lien or a second mortgage or something like that, those are all called junior liens. So the senior lien, that first position mortgage or lien, has all the seniority. So if anything was to happen to us, or if RJ and I did not fulfill the obligations that we're signing on that promissory note, then the repercussions would be that senior lien holder, that private lender, could come in and get our deal. Right? Now, we've never had a deal go bad. We've never not paid a private money lender back, but that is how you reassure your private lender that their money is safe, right? They want to know what the collateral is. And when we're buying these properties at a deep discount, I mean, a lot of these lenders would probably end up better off if we did default. If we did, end up losing the house, they're going to end up with more money because they're going to get this asset that we got a deep discount on. So that's what we do. That's why we work with a private lender. We pay double-digit interest rates oftentimes for the private money so we can buy this thing and act quickly, and we're buying it as is. That's why we can't rely on a bank. A bank is not going to be able to act quickly, and the bank will only lend on stuff after it's already fixed up. We're buying this thing as is. That's why we got to use the private lender, and then the private lender is going to fund the purchase of the property as well as the construction to rehab this property, and then after it is rehabbed and after it's fixed up, now we can take it down to a bank and do a refinance, and that is what you know of already, the BRRRR method, if you will. Buy, renovate, refinance, repeat. Rent in there as well. There's another R in there. But what other questions do you have so far about the process of buying off-market deals?
So I guess one of my questions would be is when you're cold calling, which I know some people that cold call. I mean, what do y'all think that the percentage of people who are willing to sell when you're out cold calling, or some of these getting vetted before, where you're not just calling 1,000 people who showed up on the list, or how's that work? And I'll take this one, RJ, because I've been working with our cold callers. I've been kind of taking on that role within our company, but a very low percentage of people want to sell. That's why this is a persistent game. You have to be persistent, and you have to be willing to get a lot of no's before you get a yes. But that's anything worthwhile. You're going to get shut down a lot before you get somebody who's going to say yes and buy a great deal. You can't you can't just assume you're going to pick up the phone one day and you're going to buy a house and build wealth and create financial freedom just right over the phone on your first day. It is going to take some persistence, and our cold callers make hundreds of calls a day just to get leads, and there's no guarantee that the leads are even going to convert into deals. So I would say less than 1% of the people that we call actually turn into deals, but that's okay, because that 1%, or the houses that we are buying, those are the houses that are going to set us all free and create the financial freedom that we're all trying to do. But you got to be willing to hear the word no quite a bit.
Right. Okay. Yeah. And then one of the things that you want to do when you're talking to these motivated sellers is you got to build rapport first before you start talking money.
Right.
You got to understand what their situation is, and a lot of them are going to be pissed off. Okay, so you got to hang in there and try to get the conversation going around family, occupation, or recreation. And you're going to get a lot of no's. It's okay, but if you're doing that marketing that we show you how to do, you're going to get more leads. And there's going to be one that's going to be like, Nathan, I'm glad you called me. I didn't know where to go. I didn't even know what to do. Like, we get those calls all the time. You get the handful that are going to tell you to hang up, are going to be pissed. But family, occupation, recreation is what we teach to build quickly rapport over the phone.
Build a rapport, talk about the motivation of why they're selling before you talk about the money. And remember, you want to make a friend over the phone when you're talking to these people, because if they don't like you, there's no chance in heck that they're going to sell you the property. And we see new investors all the time. They come right in, they come in hot and heavy, they want to talk money too quick, and they end up turning the seller off and end up losing the deal. What other questions come to mind?
So you found the property. You want to find the property first before you find the private money, correct? I mean,
yes.
You need to have the deal first.
Correct,
right?
yeah. You're not going to have somebody wire you money and then go shop for a deal.
Right.
Yeah.
So get the place, get the house, get the private lender on board, sign all the paperwork. So what happens now? I mean, y'all are mostly in Ohio, right?
That's correct, yeah.
Are y'all buying any houses that are far away where you can't go visit the rehabs every day? I mean, I'm probably going to be doing this remotely. So how is all that working? Do you have trusted contractors all over the state, or are you just making contacts by calling a bunch of different contractors to figure out you're not getting messed over or whatever the case may be?
Yes, I'll let RJ talk on the contractors, and RJ just did a very good video. Check it out. It's probably online, but you can find it. RiseWithTheCream.com is our community. It's a paid community where you have access to RJ and I, and we go through this stuff weekly and do weekly coaching with our community. But I wanted to touch real quick. We left a step out. So when we're working with this seller, after we have the property in contract with the seller, every single contract that we write is subject to an inspection. So we're going to get this property inspected, even if it's not, especially if it's not, in our local backyard. So we're going to have somebody go and inspect this property, do a walkthrough, take over 100 pictures, and we start to get a real idea of what's going on in this property before we close. So every agreement that we sign with a motivated seller is subject to this inspection, because if the inspection comes back and it just needs way too much work, we're probably going to need to renegotiate that deal or probably walk away from the deal, and that's okay too if you just can't come to terms. So with that, you got to get your property inspected, but you get the property inspected after you're in contract. So that's our process. Get the property in contract. You're not going to want to send an inspector out to every lead that you're working, but after it's in contract, this person's serious about selling. That's when you're going to send somebody over, get all these pictures, and really evaluate these pictures, and that's going to kind of protect you, protect your lender, so you know what you're buying. But RJ, touch on how we protect ourselves from contractors. Hello, John Harrison. I see you on there.
So, look, if you need boots on the ground, okay? So you're going to have to rely on your home inspector, or maybe a realtor, right? Who can act as an inspector for you, or you can get pictures from somebody there that you're going to probably pay an inspector to inspect the property first time around, during the rehab, and then after the rehab, okay? So you just got to factor that into your process if you don't have boots on the ground. So what it looks like for us is we have documents that protect us from rehabs that will go wrong. So, we have to vet out our contractors. You got to get references, you got to see work, you got to talk to other investors that they work with or realtors that they work with. So there's a vetting process, okay? You never want to give up. This is controversial because there's probably contractors watching this. You never want to put out an upfront deposit, okay? A lot of them will say, well, I need materials. Well, when you're planning this, you should know what materials are going to go in. to your house, not the other way around. You don't want the contractor telling you what to put in the house. You do want them to tell you, hey, I know you didn't see this in your scope of work, but I suggest you do this because, you know, this is broken, right? But you should have your game plan up front. You need your scope, you need your material list, and you need to have an internal number of what the rehab is going to be. Now we show this, we have an actual template that if you guys want that, you have to join our community, our coaching community, but we give you a template of what cost of construction should look like in most of the markets, okay? Now, we're in Ohio, this is Alabama that you're gonna be buying, so the prices are probably the same. If you were buying stuff in San Diego or New York, there's gonna be a fluctuation of prices there. So you need to know your internal number, and you need to vet out your contractors, and you need to have your plan, and you have to have boots on the ground in that market to manage your rehab remotely. So never pay up front a large deposit, okay? Run away from the contractors that are gonna say, well, I need half up front. You'll never see them again if you give them that money. And then you need to have your documents in place, construction schedule, your scope of work, your independent contractor agreements, what we call it. So those are some key points when managing rehab. And you have to manage by paying at the end of a certain week for schedule. So maybe week one's a lot of demo, removal of trash, getting it ready for paint and all that. Well, this contractor needs to show you that they've done this. And I would have my home inspector go and check.
Right.
Because that's someone third party to check your schedule. Okay.
Awesome. Thank you, RJ. And what other questions do you have? By the way, happy anniversary to John and Jeannie Harrison. Special happy anniversary to you all. So what other questions do you have?
I want to go back one little.
You're fine.
With the wiring the money from the private lender, they're going to wire just the money for the property in full, right? And then are they going to wire you personally the rehab money, or that is that going to the title company? And the title company is just paying you, giving you a check back at closing.
It's an excellent question. And when we're doing this, we have relationships with our private lenders, John Harrison being one of them. Basically, you never want to accept direct money or to accept a direct wire from anyone, really. From any of your lenders. This is a formal business closing. So yes, the entire amount of money for the purchase of the property as well as the construction, all of that is also secured within the promissory note. It's also, referenced in the mortgage, the amount that they are lending, and then will definitely go to the title and escrow company, not to you directly. And then the title company will have the instructions on how to release that money. When you're first getting going, your lender may want to, lend that money in phases, in draws, right? After you kind of got some track record under your belt, a lot of lenders will be okay with giving the whole money up front. But when you're first getting started, you can potentially expect to have your money for the construction released in draws. And that's even more important, and why you want to pay your contractors in draws as well. Don't give them all the money up front, but that will definitely go to the title and escrow company.
Right, because they're not gonna, if you're just starting out, there's really, you kind of, at least imagine you might have to sweeten the deal a little bit on the first one.
Yes.
To get them to get the money the first time. Once
Yes.
you've proven yourself, I'd imagine it's a little bit different, but the first time.
You have to pay to play when you're first building your track record in your career. RJ, maybe you can touch on what we've seen in the past with people, new investors who kind of never really get off the ground, and kind of what we've seen in our experience.
Yeah, that's called waiting for the most perfect interest rate and the perfect situation to get started. And a lot of those investors haven't done a deal yet. And they're never going to do a deal because they're in their own way. And in the beginning, when you don't have any credibility, you don't know, a private money lender and a hard money lender are taking a huge risk on you. You're going to have to pay a little bit higher interest. You might even have to give up some equity, but guess what? You're going to learn from that first deal, and you're going to build your credibility, and you're going to do many more deals. But you have to be okay with paying a little bit more upfront to earn your stripes. And sometimes that ends up holding some people back because they want to wait until, like, I'm not going to pay 10%, I'm paying 9%.
Yeah, yeah.
And then 5 deals go by them because
exactly.
you have investors that are okay with paying a little bit more and know that there's value in building that relationship long term. Right. See, private lenders aren't going to show you all of their cards. You know, they might say, yeah, I got about 50 or 80K that I want to get moving around with you guys. But really, what they're doing is they're testing you to see if they can trust you. And, you know, we've built all that trust over the years by always paying our lenders first.
Right. We've never not paid a private lender back, just for the record.
So then what happens is not only do they trust you more, but then their friends are getting involved, and this whole big network of private lenders are at your fingertips because you took care of the one.
I mean, that's where y'all are at now, right? I mean, you have a plethora of private lenders to help, you know. So I guess that's what everybody's striving for, but
you got to pay to play. When RJ and I first started out, we were giving up half of the deal. But guess what? Let's pretend you're giving up 50% of a deal, but you're still keeping the other 50%. It's a lot bigger than zero. You know what I mean? Some people, they never really get their business off the ground because they're constantly stepping over the dollars to scoop up the nickels. They're constantly shopping. Oh, I would never pay, you know, double-digit interest rates. I would never pay this stuff. Well, you're never going to do a deal. And especially when you're first earning your stripes, as you get better and you have that credibility kit and you can show all the houses that you've done, the rates and the terms will get better because now you're less of a risk, right? What other questions come to mind?
I think on the rehabs, I mean, not on the rehab side, I think that the refinance, I mean, is there any, you know, I haven't been through that part of it, but is there any issues with when you go to the bank and refinance? I mean, how does that whole thing work? I mean, I bought a house, right, and I've gone through the conventional loan, but when you're coming in with a property that was private money lent, is there any issues there with getting a conventional loan?
There's several things involved in that refinance that a lot of people don't talk about that we can address. The credit's important, right? Your credit is important. So, you know, there's this mistake that people get into real estate. No, you don't need your own cash. You don't need credit. Like,
sounds all sexy and good.
Credit needs to be in order. So work on your credit as you are, you know, establishing yourself in your business, because when you do refinance, this bank is going to say, who are you? What's your credit score, right? They're not going to look at anything else but your financials. So you need to be financially sound. So build your credit. Credit's important. They're also going to look at your deal. You know, is your debt service coverage ratio, right? Do you have a good debt service coverage ratio on this deal? That means, and Dave, you can talk about that.
Sure.
They're going to look at your financials on the deal.
Yes.
And they're going to want to make sure that it's something that they can lend on. Talk about that DSCR.
DSCR stands for Debt Service Coverage Ratio. And what that means is how much of the rent is able to cover the mortgage payment. So let's pretend, and in most banks, they want to see a minimum of 1.25% on the DSCR. They want to know how much of the rent is going to be used to pay back the mortgage payment. They want to protect their interest in this deal if they're making the loan. So a lot of lenders want to see a minimum of 1.25%. So that means if your mortgage payment is $1,000 per month, the bank wants to see this property is rented for at least $1,250 per month. So 1.25% is the minimum. So if it's not, I mean, if your mortgage payment is going to be $1,100 per month, but it's only rented for $1,250, the bank is not going to want to do that deal with you because your DSCR, your debt service coverage ratio, is not at least 1.25%. So what that means, everybody, is, you know, we're not targeting these super high-end houses. We like our sweet spot really between 120 and like 200, 210, because in our marketplace, after you get above a certain number, after you get above that 200, 210, the rents stop keeping up with the value. So, let's pretend a $150,000 property in our market will rent for $1,500 per month. Well, a $200,000 property still is only renting for like $1,550. So as you get up in the value, that means the mortgage payment is going to be higher. The bank is looking at that because you have to finance more. But if the rent is not keeping up with the increase of the monthly payment, the increase in debt, the bank does not want to do those deals. So you got to make sure you're targeting properties in a price range where the rent is going to more than cover the mortgage payment, or the bank's never even going to do the loan. Does that make sense?
No, it makes sense. And I guess a question on top of that would be, how did you go about proving that you're going to be able to get that amount of rent out of it? Or is that just on historical rental history in that area, or?
The bank does their own due diligence, but it's pretty well known. And if you know your marketplace, you gotta, that's part of what RJ was talking about. You gotta understand your values, your after repair values, but you also have to have a pretty good general idea on what something's gonna rent for. And a lot of times the bank doesn't want to do this refinance until the property is already rented. Right? So this property is rented out. They're going to be able to see, back to our example, your mortgage payment's going to be $1,000. They're going to want to see the property is already rented for at least $1,250 per month. So you, as the investor going into this as part of your due diligence process, not only are you looking at the after repair, what's the property going to be worth after it's fixed up, but you also need to kind of know what you're going to be able to rent this thing for, so you don't run into any problems on the refinance later.
And is debt to income ratio going to have a matter, since you're doing, obviously in a conventional loan, they're looking at debt to income ratio, right? But on an investment property loan, is that as big of a factor, being that you're already showing rents and you're offsetting the debt essentially right off the gate when you go to refinance with them?
Debt to income ratio is not as big of a factor when you're doing these investment properties. But what they do want to often see is liquidity. They want to see that you have money in the bank, and that you're just healthy financially. But when you're doing these refinances with like an investment loan, like an institutional lender, the debt to income ratio is not as important as if you were buying a primary residence for yourself and your family.
Right.
But they do want to see that you've got some money in the bank. You can't be... And like RJ said too, the credit. I don't care. It sounds so good. You see these books, it's like no cash, no credit. I don't think we've ever not had our credit pulled from any refinance. It's just the way it is, right?
Yeah. That's good for flipping, but when you grow up from that and you're actually going to buy assets, that's the long-term play of creating wealth. You got to get your credit in order. So, what other questions you got? Maybe?
I think as far as that, renting it out and stuff, that's not really you should already know that, right, by the time you've gotten to this point, what it can rent for.
Zillow's good, Rentometer is good.
It really is.
Some comps that are out there. And then you can also call property management companies and see what kind of rent you can get.
Yeah.
So that's where you're going to get those comps.
So check that out. RJ just gave some good resources. Zillow, say what you will, a lot of realtors, and we're friends with a lot of realtors. We poke fun at Zillow. Everybody does. And that's another conversation, but it's been crazy. We're in a raging hot real estate market, but the Zillow stock, I don't know if you guys pay attention to that, is like, it just keeps getting worse and worse. It's like getting destroyed. I don't know why, but that's another conversation. But Zillow is actually really effective for looking at rent comparables. They're actually really accurate. And the other resource that RJ gave is Rentometer, and that is at basically rentometer.com, rentometer.com. Check that out as well. I think it's a paid service, but it's very inexpensive, but it's very accurate rent comparables. Cool?
Yeah, I think that's pretty much all I had.
This has been a presentation of The Cream, Cash Flow, Real Estate and Money. It's your boy Dave P., RJ Pepino. You can follow us. You can get on the phone with us weekly. Join us, risewiththecream.com. And we will see you on the next video. Thanks, man.